Hi, it's Greg Goernert, Vice President and Senior Investment Advisor of Canaccord Genuity Wealth Management and Goernert Wealth Management. Now here on this channel, we try to solve your financial problems. Now, joining me today is Canaccord Genuity North American Equity Strategist, Martin Roberge. Martin, how are you today?
I'm excellent, and thank you for having me on your show.
It's always a pleasure, and I do appreciate you taking the time to join us. Now, you've come out with your monthly commentary on the market right now, and I just want to talk a little bit about what you've said, your latest quantitative strategist that you put out. You've been overweight commodities, and you've got some other thoughts on where we are in the marketplace right now.
Yeah, because the landscape or the interest rate environment has really changed over the past 2 months, and we've seen a very stiff increase in interest rates, such that we're having some market volatility in some areas of the market. But this volatility marks a transition from previous leaders to laggards of those areas of the market that have lagged the market indexes. And this is obviously positive to the extent that those sectors are very cyclical in nature, and they tend to do well when the economy improves. Obviously, there's a limit to how high interest rates can go without choking the economic recovery, but we're still not there. So we welcome the increase in interest rates, which is validating the economic recovery. And I would say that probably the most important point at this time for equity investors is first to have a position in equities, and then a diversified position, not a bullet one, but be as much as possible in almost every sectors of the market, as opposed to focusing on just one area of the market, which for example has been technology for several years. Now it's time to really diversify, probably away from this area into the other cyclical areas of the market.
Yeah, that's an interesting point. Now, a couple of things. I hear a lot from clients right now and investors in general going, they're a little leery about the equity markets, that things have gone. So I want to talk to you about that. And then my next thing that I just want to bring up is, I tend to think that, maybe interest rates have gone up too far, too fast. Sorry, not interest rate, but bond yields have gone up too far, too fast. What do you say about that?
Yeah, that's fair. We looked at, since 1990, there have been about 9 what we call rate shocks. Like we looked at rate shocks that occurred early in the year, and we looked at the rest of the year, how it would shape. And this time around, interest rates and bond yields have really risen higher than what the historical script would suggest in a rate shock environment, which is why we believe that probably the bulk of the interest rate increase for the year is behind us. History shows that probably May, June could be or should be the ultimate peak in bond yields. So the good news is that we are maturing in this rate increase cycle. But again, looking at past rate shocks, bond yields would normally peak around the summer and then gently go down in the second half of the calendar year. So to the extent that the equity market has been volatile owing to the increase in interest rates, well, knowing that most of the interest rate risks will be discounted or over by this summer. As you know, the stock market is a leading indicator of the economy. So now is the time to use dips in the market to position portfolios for the second half of the year, which will probably be more positive, to the extent that the headwinds from from higher rates will be behind us. So use the current volatility again to get positions, or at least um, have positions in either commodities or stocks, which are very the net beneficiaries of an improving economy.
Yeah, that's interesting. So if you taking from what you said there, you're tending to be underweighting bonds right now, and then you're overweighting equities in relation to bonds. Now, what regions are you looking at on equities? Are you U.S. focused, or I think I was talking with you in the past that you're kind of underweighting a little bit on the U.S. side. Is that correct?
Yeah, it's because the valuation in the U.S. is so much higher than the valuation of other markets, that you just enjoy a bigger margin of safety just in case that there are speed bumps. Areas that are uh, cheaper will usually be able to absorb higher interest rates, being like potential catalysts for volatility. And what we found is that when the global economy improves, um, other markets have more exposure to cyclical stocks. And in the U.S., it's, as you know, it's probably the index with the biggest weight in the growth stocks or the hyper growth stocks. So those stocks are fine. Like they did well last year, but I believe they need to rest. And while they rest, we believe that the other markets, international markets, which have been like going down or underperforming the U.S. market for probably almost 10 years, the year of the awakening is 2021. So I really like the attributes of international equities, and those that are geared towards an improving global economy.
You know, one thing that you comment on in the past is you have a reflation gauge. Can you talk a little bit about where we are in the reflation cycle there? Because I think that really talks to the underpinnings of where the economy is going forward.
Yeah, the reflation the reflation gauge is just a measure of how much the impact of rising interest rates, because as you know, the economy right now is doing extremely well. But if rates go up too fast, if oil prices go up too fast, it's both are a tax on the consumer. Okay, so we have to make sure that the increase in both factors is gradual. Otherwise, the reflation could turn negative, i.e., the increase in oil and interest rates um, takes some liquidity away from the economy, and as a result, disposable income goes down, because all of a sudden it is costing people more to borrow and more to put gas in their car. So right now the gauge has gone up because uh, the increase in rates and oil is tightening economic conditions or liquidity conditions, but we're not like let's say that the flag is yellow, the flag is not red yet, but over time, should we push above 2% on 10-year treasury bond yields, and let's say $70 on WTI oil prices, we would probably get like closer to the red flag, but we're not there yet. Again, like we're more into the yellow zone for now.
Yeah, no, I heard you make a comment that maybe what's been happening over the past little bit is akin to what happened in 2010. And for those who weren't around, we all were around, but after the financial crisis, when the market backed up and things started looking quite a bit better, there was an event in 2010 that really kind of shook the market a little bit. You want to comment a bit about that?
Yeah, it's yeah. When you look historically at years following a recession, that year is really good for equities in general. But the second year,
Mm-hmm.
which is 2010,
Mm-hmm.
the recession was 2009.
Yeah.
So the year of the recovery, sorry, the first year of the recovery was 2009. The second year, 2010, we had a lot of speed bumps. The market did very well in '09, and then early in spring, we had the beginning of the Greek sovereign debt crisis. As you may remember,
I remember
Greek
that.
almost
Brexit. Yes.
Grexit, and then it turned into the European debt crisis, because we thought a Greek would take down other countries with them, such as Italy,
Italy,
Ireland,
Spain,
Portugal,
Ireland. Yes.
Spain,
Yes.
and 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 this growth shock um, created some market volatility, and and we had back then like almost two back-to-back 10% corrections,
Mm-hmm.
and then we went back up again 2012, and then back down because of the European debt crisis.
Mm-hmm.
But overall, when you look at this episode versus where we are today, the backdrop is totally different. Um, when you look at uh, like sovereign debt spreads, are the financial conditions of several countries is much better than it was back then. And actually, if you look at Greek spreads, currently are nearly back to where they were uh, in 2009 before the Grexit experience. So we've gone a long way
Yep.
in providing bridges to corporations, to individuals, and to governments, such that financial, what we call financial conditions, are much looser versus where we were in 2010. So, of course, this time around, it could be different. We could have another shock from nowhere, um, hurting the equity market. But um, the fact that liquidity conditions remain much more accommodative than in 2010 makes me believe that um, potential market corrections will be shallow, and as a result, um, they should be used as an opportunity to increase equities. And if I can say that the good thing about the economy versus the last 20 years is that uh, it's been mostly growth shocks hurting equities in general. And this time around, it's not going to be growth shocks, but rate shocks. The good thing about rate shocks is that the risk of a recession are low, because rate shocks occur because the economy may be speeding up too fast. So
Mm-hmm.
as long as we stay away from the recession risk, or what we call a monetary overkill, where central banks are rising rates too fast because they want to slow the economy down, as long as we stay away from this scenario, we believe that uh, corrections will be tactical in nature, and the path of least resistance for equities in general is up.
Now, that's a good point. Now, you brought up rate shocks, and I know that rate shocks is part of the three risks that you monitor. Can you flesh out the other risks that you monitor going forward here?
Yeah, the we look at also the earnings revision risks. Um, right now, companies are doing extremely well, but there's always a risk that when companies do well, analysts extrapolate the good news into the future,
Always.
and
Take a
then
straight
what
line, right?
happens
Doesn't
is
work.
that if there's for let's say for a reason the economy slows down because of the variance, for example,
Yeah.
or we postpone the recovery, well,
Yeah.
there's an earnings risk. So
Mm-hmm.
this risk has to be monitored. So far, so good. And again, like the third risk is not the rate shock, but the reflation shock that we talked about. If commodity prices, especially oil, were to go up too far too fast, it could be a tax on growth, tax on the economy, and again postpone the earnings recovery, very aggressive recovery projected by equity analysts for this year. So those are the three risks that we monitor.
Yeah, no, as far as the three risks in relation to rate shocks, um, talking and hearing what I'm hearing from central bankers out there, what are your thoughts about? I mean, there's obviously been a lot of central bank activity in the bond market as well. Now, has that changed your view of which proxies you look at, and then what could we see something like an Operation Twist that happened back in I guess 2010
Yeah,
again, as far as
yeah,
open market operations with central banks, and what would that mean for your the underlying?
yeah. The reason why eventually central banks could come back and start and try to maybe limit the increase in interest rates is because they're willing to take an inflation risk. And the one thing that they are trying to do differently than in the past is to achieve full employment, not so much for the average individual, but for the low and the middle class. This is very different than in
It's
the
different, yeah.
past, because that means they will let run the economy hotter for longer, and this means keeping interest rates lower for longer as well. And the risk eventually is that the bond vigilantes or the bond market says, you know what, uh, there's a risk that you fall behind the curve, the inflation
Yep.
curve, and then you get this backup in interest rates, which chokes the economic recovery. So there could be doing eventually Operation Twist. Operation Twist only means that the government sell short-term bonds to buy more long-term bonds in order to put a cap on the bond yields. And the reason why there's always upward pressure on yields is because, of course, the economic recovery, but the US government is issuing right now more bonds to finance the deficit, the budget deficit, than what they are buying under
Yeah.
the quantitative easing program. So there's a disequilibrium between the demand and supply of bonds. And eventually, if on top of having like this supply shock from treasury bond issuance, economic pressure because we're recovering, then there's the inflation pressure.
Yeah.
Well, that's a toxic mix for the bond market, and we could see a twist. And the twist, the good thing, would probably kickstart the demand for inflation protection. And as I said many times on your show, like the only area that will provide that protection is the gold sector, and probably some of the hyper growth stocks that are less sensitive to interest rates, because interest rates would be moving sideways. So removing this interest rate risks would allow some of the higher multiple companies to regain some market leadership. So, but personally, I believe that gold and gold equities should be your prime protection against a risk that central banks fall way behind the inflation curve, and that central banks have to cap interest rates
Yeah,
in order to avoid like a melt up.
yeah. I mean, and that's such a good point, because I think as long as I've been in the business, and I obviously, going back even 35 years before I was in the business, for the past 35, 40 years, the bond market has been in a bull market. So you've not gone wrong by whenever there's been, a pullback in the bond market to invest there. Where do you think, now we're at near zero, sub-zero rates right now. Where do you think we are on that thesis? Do we have to think that maybe it is different this time, that maybe when you see a pullback in bonds, that it's maybe not the time to be jumping in?
Yeah, that's it's let's put it this way. For this business cycle, I believe that cash should be favored as a tactical shelter. As a shelter, uh, cash will probably do better than bonds, because as I explained before, like the amount of liquidity, like the monetary liquidity, fiscal liquidity is huge. And the reason why we are getting so much liquidity is because we want to boost growth so that employment, full employment, is achieved not for the average investor, but for the not only the average investor or the average citizen, but the low and the middle class as well. Mm-hmm. So that requires a lot of gasoline to get that growth, that strong growth. And what I believe we will see is the bond market always discounting the possibility of an inflation risk down the road because of excess liquidity, which means that bond yields should move in a lockstep fashion. It's like we've moved from 150, we're going to stabilize, and then we're going to go to 175, we're going to stabilize, and then eventually we're going to go to 2% and we stabilize. The key here is to make sure that we go there gradually, okay? Right. But it makes no doubt that the risk is that we go too far too fast, and the central banks will be using like the Operation Twist, for example, to ensure that this is a smooth transition. But bonds will not protect you to the extent that what we are looking going forward are rolling rate shocks or inflation shocks rather than growth shocks. And there's a big difference between a growth shock and a rate shock. Growth shocks, bonds will rally. Bonds will get the equity money when we go down because it's a growth scare that right. takes the equity market down. This time it's an interest rate or / inflation scare right. that is taking sometimes the market down. So cash becomes, unfortunately, a temporary shelter, but to replace bonds, well, you have to look elsewhere into the alternative investments. Preferred shares is one possibility. Infrastructure, commodities. We have to probably work harder as an investment advisor to find those the portfolio diversifiers, because the 60-40 asset mix, 60 stocks, 40 bonds, will not work anymore if I'm right about the business cycle.
No, life used to be so much easier as an investment advisor back then. 60-40, done, awesome.
That's it.
It's not that way. It hasn't been that way for a few years. Martin, why don't we leave it at that? Thank you once again for joining me. I really appreciate awesome insights. Martin Roberge, thank you.
Thank you.